Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit in current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof of your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, we're celebrating today. We celebrate every day on Ron Siegel Radio. I love to celebrate, especially when it comes to food. I've beaten anorexia. Today's National Cheese Curd Day. Unique appetizers that you can eat. One bite brings you straight to a warm, buttery crunch, followed by an ooey gooey burst of Dairyland delicacy on the inside. Unaged curdled milk with a mild, salty flavor and a springy, rubbery texture. I don't know if I've ever had, I know I've had, it looks like I guess when you look at the pictures, well, it's almost like a cheese dumpling, right? Deep fried cheese. You got to have a fancy name for it, I guess, if you're a chef, though. So you just can't go with, deep fried cheese. Because that's like, I wonder if mozzarella sticks would be considered cheese curd. I don't know, but I like them. Speaking of like them, ooh, this is a good one too. Today is National Shawarma Day. Yeah, I like shawarma. Now, I don't know about that. Okay, Josh, it looks like you got a burrito there. Okay, we those, I like the pitas. They're a little thicker than the normal tortilla. Tzatziki sauce inside. You got to like that one too. So Shawarma Day is today as well. So we'll be eating our way through the day. Although it's probably just a one and done. I've gotten to the point that with these shots I've been taking and 92 pounds lost, it's I don't eat nearly as much as I used to. And when I do sit down, here's the problem. And I don't know if you're a skinny, a fit person, I shouldn't say skinny. If you are a fit person, you may not understand this, but us, fatties, we just think about food all the time. We don't eat because we're hungry. We've never really been hungry. Do we know what hunger is when we're morbidly obese? Yeah, probably not. So we just eat because it's there or it's not there. We go find it. So, but now when you get full so quick, then you start feeling uncomfortable, which my doctor says that's a good thing. When you have that uncomfortable feeling, basically what's happening is it's a good reminder. Hey, stop eating, dummy. Okay, so we got that one there. Hey, let's see what the markets are doing today because this is a home and finance show. But it's a challenge right now because with the government shutdown, all of the reports that we normally get on that we could talk about, well, there's nothing going on. But I still look and see the Dow Jones Industrial Average is up 85 points. NASDAQ is up 157. S&P 500 is up 35.51. I'm going on the road today, so let's take a look and see what gas price. Yeah, we don't want to take a look and see what gas prices are doing, because I can tell you that oil is at 58.46 a barrel. We are getting to the point where it's a little low, because you start looking and saying, okay, are the producers going to keep producing? And we did get a massive amount of production recently. Drill, baby, drill. And so we're seeing that production going up. Consumption is not going up. But the cost of a gallon of gasoline, other than in California, it's going down. So should we look at it? I'm going to be on the road today. So $4.65 a gallon. Yesterday it was $4.65 a gallon. The national average is down almost a penny, 306, and 306.7 is the national average gallon of gasoline. Are you under $4, Josh? Yeah, you're probably what, 360, 370, 350 in that range. Yeah, so think about that. They're even in Nevada, they're about $1 a gallon cheaper than California. And now there are, well, I'm looking at probably about half the states in the union are under $3 a gallon. Half are under $3 a gallon. Yeah, California, we're pushing $5. Unbelievable. And Gavin wants to take over more of our economy because he's done such a great job on everything else. Think about this. Look at Gavin Newsom's history. San Francisco, yeah, it's gone down the toilet. California, we've got massive wildfires because there's no water. We've got gas prices out of control. We've got people leaving the state, and look at the crime in LA and San Francisco. Good job, Gavin. Now maybe you can do that for the whole country. And I don't know, Josh, do you guys see much of Gavin there in Nevada, or do we just have to deal with him here? Oh, you see the garbage from him there as well. Okay. So unbelievable, but let's watch and see what else is going on. We did see Treasury Secretary Bessent. Stock market decline won't deter the U.S. from taking strong action against China. So the trade war is heating up. Those that think the president's going to back down, probably not going to happen. Did you see what happened with Hamas, though? I mean, that's you look and say, okay, they released the Israeli hostages. They've only released, I think, 4 of the deceased now out of, I think there was 24. But they're back in control in Gaza, and they were showing public executions yesterday. So, I guess there's still more work to be done out there in the Middle East. But if you watched the president yesterday, he did make some strong comments saying they will disarm or they will be disarmed, one or the other. So it's going to be interesting to see. And watch your if you're a subscriber on our community, rsrlinks.com/HBOD. If you are a subscriber, watch out there. We're going to be putting out a message later today. So it is our take 2. It's the 1 week a year that we say take 2. What does take 2 mean? Well, if you restructure your existing home loan this week, get your application in, all your documentation in by Monday. And if you're doing a debt consolidation, cash out, rate and term, whatever makes sense for your family, well, it's going to close in such a way that your first payment won't be until January of 2026. So you're going to be able to take 2 payments off. Think about that one. What's that going to do for your cash flow? So we're going to call that the rsrlinks.com take 2, which I haven't even made anything for it, Josh, but we'll have to figure something out in there. But think about that. It's going to be the RSR take 2. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, 2026 housing market outlook, understanding credit scores and mortgage rates, the hidden cost of set it and forget it insurance. All that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, #1 on YouTube. Stay tuned. We'll be back in just a few.
Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by rsrlinks.com/mobile app. rsrlinks.com/mobile app. And every day at this time, OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They do not tell us points paid, points received, or the APR. They tell us the number you need to put in your mortgage calculator to figure out your principal and interest payment. What did rates do yesterday? They were mixed. Conventional 30-year fixed down 6.218. Jumbo 30-year fixed up 6.483. FHA 30-year fixed down 6.124. VA 30-year fixed up 5.876. USDA 30-year fixed 6.021. That was down. Those are the rates from yesterday, and we're always looking at where they come in on those numbers. So let's take a look and see what the markets are doing today. And if you want our thoughts about the market, the whole idea is go to our community. We put that out there, rsrlinks.com/HBOD, rsrlinks.com/HBOD. And we put that out there each and every business day morning as early as the data allows. And yes, it has been posted today. And I don't know if that gets out to our social channels or you just have to go right to our board of directors, household board of directors. That's what that stands for. So if you go into the community, you'll see that. But what are the markets doing today? Let's take a look. The 10-year treasury, first off, it's flat, 4.02. Call it 4.03 if we round it off. The mortgage bond, that's up 4 basis points. Not doing a whole heck of a lot. And again, when that bond goes up, anything going up is good because that means interest rates are going down, but it's such a small number. The S&P 500 is up 38 points right now. Why is all this happening? Well, yesterday, Fed Chair Powell spoke and made some new comments on the Fed's balance sheet. Powell said that there are signs of liquidity tightening and the Fed may stop reducing their balance sheet in the coming months. I believe there is a good chance that the Fed will announce this either at the October 29th or December 10th meeting because they are worried about liquidity. There's a good chance it is announced this month on October 29th. This could have a positive impact on rates. Currently, the Fed is allowing up to $35 billion per month in mortgage-backed securities and $5 billion per month in treasuries to roll off the balance sheet, reinvesting any proceeds above that back into treasuries. It's unclear how much of the allowed $35 billion runoff in mortgage-backed securities is being reached, but it's likely to believe they are not reaching the full cap because of volume and that they are allowing 15 to 20 billion to run off. If the Fed stops the runoff altogether, the Fed would then reinvest roughly 20 billion per month that they're allowing to fall off their balance sheet, likely into treasuries. Powell feels that the Fed is overweight long duration treasuries and underweight short duration, and the average duration is about 7 years. That means that the Fed will likely focus their investments at similar duration and more towards the shorter maturities. So the mortgage bonds are a longer maturity because People keep their mortgages a little bit longer. So that's a longer maturity. And when you talk about the runoff, why is that important to you? Well, it's all about supply and demand. When the Fed lets it roll off, well, that means there's more supply coming into the market. The Fed's not buying those bonds back. When there's more supply, well, then when the Fed starts buying the bonds, that's going to cause the price to go up. When the price goes up, rates go down. When there's more supply, price goes down and rates go up. So we're watching that very, very closely. The Fed stops the runoff altogether. The Fed would then reinvest the roughly $20 billion that they're allowing to fall off the balance sheet. We said that will help rates, especially if Besson is successfully in terming our debt shorter and issuing less long-term paper. Again, less long-term paper. That means there's less supply. If the supply drops, then we're going to start seeing more. The demand is going to be outweighed, and that'll bring the price up, rates down. He appears to be getting more and more comfortable with tariff inflation being temporary. And while he is coming around on the labor market being weaker, he's not fully there. It's hard to imagine how we could say that the labor market has little changed since the last look, when the latest ADP report showed 32,000 job losses. And you know my thoughts about Jerome.
Such an idiot.
Yes.
Such an idiot.
Nonetheless, the balance sheet news did help bonds and stocks later in the day, as it's a form of removing restrictiveness. So watching all of that, that is the mortgage app. Did the screen go black on you, Josh, or it was just me? Okay, maybe I guess Josh was mute, but that's normal for me. Let's see. I think we've got what do we have here? Mortgage 101. Yeah, Mortgage 101 brought to you by what is it going to be? GetHomeSelect.com, GetHomeSelect.com. What if I told you that a difference of just 140 points on your credit score could cost you over $120,000 in extra interest? Stick around. This one's a wallet saver. I'm Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Here's something most people don't realize. Your credit score doesn't just determine whether you get approved for a mortgage. It determines how much that mortgage is going to cost you over the life of the loan. Let me break down some real numbers for you. These are based on national averages a couple weeks ago for a 30-year fixed rate mortgage of $500,000. Now, I need to look at this. I'm going to give you this bit. So again, this was a couple weeks ago. If your credit score is between 760 and 850, you're looking at around 6.92% APR interest. Remember, loans locked yesterday at 6.218. So it's going to be significantly cheaper. But we did this, and I want to just get the numbers out to you. Again, $500,000 mortgage. So credit score between 760 and 850 or 6.92% APR. Your monthly payment would be around $3,308, and you'd pay about $690,000 in interest over 30 years. Now, if your score drops 700 to 759 range, your rate jumps to 7.23. Again, that was a couple weeks ago. That brings your monthly payment to $3,404. And here's the kicker. Your total interest paid climbs to $725,000. Drop down to the 680 to 699 range. Now you're at 7.33, paying $34.38 a month. Total interest, $737,824. And if your score hits between 620 and 639, you're looking at 7.93, which means $36.46 a month, and a whopping $812,000 in interest. Ow! So what does this mean for you? The difference between the highest and lowest credit tiers is $338 per month. But here's what really matters. That's $122,231 more in interest paid over the life of the loan. That's not chump change. That's a second home, a college education, or a very comfortable retirement. Now I know what you're thinking. Ron, my credit score is what it is. What can I do about it? Plenty. Start by paying every bill on time. Your payment history makes up 35% of your credit score, so this one habit can move the needle significantly. Pay down your credit card balances. Keep the utilization rate below 30%. Again, below 30% of the credit limit, ideally below 10% if you can manage it. Pay the credit card bill the right way. rsrccpayment.com, rsrccpayment.com. I say it over and over again. I hear people all the time tell me, well, Ron, I pay my credit card bill in full every month. When? Well, right after I get the statement. How else? You paid it wrong. rsrccpayment.com. We show you how to pay it the right way for FICO scoring purposes. Get a free copy of your credit report from annualcreditreport.com. Dispute any errors you find. Now, remember, you can also monitor your credit report, rsrlinks.com/keysteps, rsrlink.com/keysteps. So you're going to monitor your credit report on a regular basis. This is not a FICO score. It's a credit score updated once a week, but it also looks out for identity theft. You get notified immediately when your credit is run. And oh yeah, it's got a simulator on there saying, if you pay this much, this is what you can expect to happen with your credit score. And I've seen clients gain 30 to 40 points just by cleaning up mistakes on their reports. And here's what not to do. Do not close old accounts. Do not open new lines of credit right before you apply for a mortgage. Both of these moves can hurt your score. Remember, strategy beats rate always, but in this case, a better credit score gets you both a better rate and a better strategic position. That's the household blended interest rate working in your favor instead of against you. If you're thinking about buying or refinancing, let's look at your complete financial picture first. Maybe your credit score is better than you think. Maybe there are some quick fixes that can save you tens of thousands of dollars. Either way, wouldn't you rather know? And remember, right now, and as I record this, it's October 15th. Right now, you've got the Take Two program. Get an application in for restructuring your debt, cash out refinance, rate and term refinance. If it makes sense, get all the documentation in by the 20th. And we'll get your loan closed in such a way that you won't have to make a November or a December mortgage payment. Your first payment will be due in January of 2026. Again, check out rsrlinks.com/keysteps to get your financial house in order, or visit rsrlinks.com/Sora for a soft credit pull and a mini loan app. You can also learn more at ronsiegelradio.com. This is Ron Siegel reminding you your credit score isn't just a number. It's your negotiating power. That is Mortgage 101, brought to you by GetHomeSelect.com, GetHomeSelect.com. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, housing market outlook for 2026, the hidden cost of set it and forget it insurance, all that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. 2026 housing market outlook. After a couple years where the housing market felt stuck in neutral, 2026 may be the year things shift back into gear. Expert forecasts show more people are expected to move, and that could open the door for you to do the same. More homes will sell with all the affordability challenges at play over the past few years. Many would-be movers pressed pause, but that pause button isn't going to last forever. There are always people who need to move, and experts think more of them will start to act in 2026. And if you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490 or FM 98.1 video feed, you are seeing a chart. We love charts. And you're seeing a chart of home sales expected to rise. Yeah. What's behind the change? Two key factors: mortgage rates and home prices. Let's dive into the latest expert forecast for both so you can see why more people are expected to move next year. Mortgage rates could continue to ease. The number one thing just about every buyer has been looking for is lower mortgage rates. And after peaking near 7% earlier this year, rates have started to ease. The latest forecasts show that could continue throughout 2026, but it won't be a straight line down. No, don't count on that. Again, you're looking at the graph. There's a saying, when rates go up, they take the elevator, but when they come down, they take the stairs. And that's an important thing to remember. It'll be a slow and bumpy process. Expect modest improvement in mortgage rates over the next year, but be ready for some volatility. There will be volatility along the way as new economic data comes out. Just don't let it distract you from the bigger picture. The overall trend will be a slight decline. Forecasts say we could hit the low sixes or maybe even the high fives. And remember, there doesn't have to be a big drop for you to feel a change. Even a smaller dip helps your bottom line. If you compare where rates are now to when they were at 7% earlier this year, you're already saving hundreds on your future mortgage payment. And that's a really good thing. It's enough to make a real difference in affordability for some buyers. Home price growth will be moderate. So what about prices on a national scale? Forecasts say they're still going to rise, just not by a lot. With rates down from their peak earlier this year, more buyers will re-enter the market, and that increased demand will keep some upward pressure on prices nationally and prevent prices from tumbling down. So even though some markets are already seeing slight price declines, you can rest easy that a big crash isn't in the cards. Thanks to how much prices rose over the last 5 years, even the markets seeing declines right now are still up compared to just a few years ago. Of course, price trends will depend on where you are and what's happening in your local market. Inventory is a big driver in why some places are going to see varying levels of appreciation going forward, but experts agree we'll see prices grow at the national level. And again, you can see what the experts are saying on the chart that we're showing on the screen right now, the 2026 home price forecasts. And if you've listened to Ron Siegel Radio for any length of time, they've got all these different forecasts on there. The National Association of Realtors, NAR, Fannie Mae, Mortgage Bankers Association. But I like the home price expectation survey. It's right there in the middle. It says 2.4%. Why do I like that one? Because it mixes everybody together. It averages over 100 of the supposed brightest and smartest people in the country. And I'm saying that, some of the NAR folks are in it. Some of the Wells Fargo people are in it. Fannie Mae does it. The Mortgage Bankers Association is part of it. These are all people that are part of that home price expectation survey. And they say 2.4%. This is yet another good sign for buyers and overall affordability. While prices will still go up nationally, it'll be a much more sustainable pace. And that predictability makes it easier to plan your budget. It also gives you peace of mind that prices won't suddenly skyrocket overnight. After a quieter couple of years, 2026 is expected to bring more movement and more opportunity with sales projected to rise, mortgage rates trending lower, and price growth slowing down. The stage is set for a healthier, more active market. So the big question, will you be one of the movers making 2026 your year? If so, give me a call at 800-306-1990. Get started on our key steps so you're mortgage ready. rsrlinks.com/key steps. Get mortgage ready now so that you are in place, and we'll put you in touch with some great real estate professionals anywhere in the sound of my voice because I've got their report cards. That is the real-time real estate segment brought to you by rsrmoney.com, rsrmoney.com. Borrow Smart segment today being brought to you by gethomeselect.com, gethomeselect.com. What if I told you that insurance policy you bought 5 years ago could be costing you thousands of dollars more than it should? And worse, it might not even cover what you think it covers. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Here's something I see all the time. A family comes to me wanting to refinance their home. We run the numbers. Everything looks great. And then we get to the insurance discussion. That's when I hear, oh, we haven't looked at that in years. Our premium went up again, but we just pay it. Sound familiar? Let me share what happened with a family I worked with recently. They bought their home 8 years ago, set up their homeowner's insurance, got their mortgage, and moved on with life. Fast forward to last month, their insurance renewal came in at $4,200 a year. That's up from $2,800 they paid when they first bought the house. They figured, well, that's just how it goes, right? Wrong. We did something simple. We reviewed their policy and got some quotes from other carriers. The result, we found them comparable coverage for $2,900. That's $1,300 a year back in their pocket. Over the life of the 30-year mortgage, that's $39,000. And we've got the insurance agents to refer you to. We know them. Think about what that means for your household blended interest rate. That extra $1,300 a year. It's like having an additional expense charging your interest you don't need to pay. But here's where it gets interesting. It wasn't just about the premium. When we actually read through their old policy, we discovered something concerning. Their coverage limits haven't been changed or adjusted since they bought the home. In 8 years, construction costs have gone up significantly. If something catastrophic happened, they would have been seriously underinsured. So what does this mean for you? Your homeowner's insurance isn't just a line item on your mortgage statement. It's part of your overall financial strategy. And just like we talk about refinancing when rates dip, you should be shopping your insurance regularly. Here's my recommendation. Review your homeowner's insurance every 2 years minimum. And I mean really review it, not just glance at the renewal notice. Look at your deductibles. Maybe when you bought your home, $1,000 deductible made sense because money was tight. But if you've built up your emergency fund and could handle a $2,500 or $5,000 deductible, that change alone could save you hundreds of dollars a year. And we've talked to you before about checking with your CPA and financial folks and see if a Roth IRA would make sense to put the savings in. That way you become self-insured for that deductible. Not self-insured, but you're insuring for that. You've got a safety net for that deductible going up. And think about it. When was the last time you made a claim? Think about that part. Check your coverage limits. Make sure they actually reflect what it would cost to rebuild your home today, not what you paid for it years ago. Special form policies are popular because they cover all perils except those specifically excluded. But do you know what's excluded in your policy? Here's another thing people miss. If you have valuable jewelry, art, or collectibles, your standard policy probably doesn't cover their full value. You might need additional coverage for those items. And don't forget about umbrella liability coverage. If you've built up assets over the years, an umbrella policy provides extra liability protection beyond your standard homeowner's policy limits. It's usually inexpensive relative to the protection it provides. Bottom line is this. Insurance is part of your debt management strategy. Every dollar you overpay on insurance is a dollar that can't work for you somewhere else. It affects your cash flow. It affects your ability to build wealth. It affects your retirement. I work with trusted insurance professionals who can provide second opinions on your coverage and rates. It's not about being disloyal to your current agent. It's about making sure your insurance strategy matches your current financial situation. You know it. Strategy beats rate always. But in this case, the strategy includes making sure you're not overpaying for the protection you need. Want to see how your insurance fits into your overall financial picture? Of course, rsrlinks.com/keysteps. rsrlinks.com/keysteps to access our financial house in order tool, or go to ronsiegelradio.com to learn more about strategic debt management. This is Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management, reminding you that every dollar matters when you are building wealth. That is the Borrow Smart segment, brought to you by GetHomeSelect.com. GetHomeSelect.com. You are listening to Ron Siegel Radio, discussing your real estate, current events, and financial markets. When we come back, understanding credit scores, all that and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. What do we have? Your Credit Matters segment today being brought to you by rsrlinks.com/debt-free. rsrlinks.com/debt-free. Think your credit score is too low to get approved for anything? Here's something that might surprise you. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. You know, I've been doing loans since 1983, and one of the most common concerns I hear is, Ron, my credit score is terrible. There's no way I can get approved. But here's the thing. What you think is terrible might not be as bad as you believe. Let me break this down for you. The lowest possible FICO score is 300. Though you'll rarely see someone at that level. FICO scores range from 300 to 850, and here's what really matters. If your score is below 580, yes, you're considered high risk. About 59% of people in that range become delinquent on payments. But what does that mean? You can't get credit? Not necessarily. Between 580 and 699, you're in the fair range. It's below the national average, means you'll pay higher interest rates, but you can still get approved. Now, here's where it gets interesting. Once you hit 670 to 739, you're in the good range. You're considered acceptable. From 740 to 799, you're very good. Only about 2% of people in that range become delinquent, and above 800, you are exceptional. But here's what I want you to understand. Different lenders look at risk differently. What one lender considers unacceptable, another might approve, maybe with a higher rate or a lower credit limit, but they'll give you a chance to prove yourself. I recently worked with a family who thought they were done because their score was in the low 600s. We found them a lender who understood their situation. Yes, the rate was higher than prime, but we built a strategy around it. That's what strategic debt management is all about. Remember, your credit score is just one piece of the puzzle. We look at your entire financial picture, your income, your assets, your credit, current debt structure. Then we evaluate everything through safety, liquidity, and return to find what actually works for your household budget. And if your score needs work, it can be recovered. Make payments on time, reduce those credit card balances, avoid new credit inquiries, and check your credit reports for errors. Takes time, sometimes months, sometimes years, but it's not impossible if you stay consistent. So what are the tools? Well, you're going to check your credit score. Keep on there all the time. And I'm saying two different tools we have. If you're getting close to applying, you want to know your FICO score. rsrlinks.com/FICO. rsrlinks.com/FICO. That's going to give you your true FICO score because it is a service we get through FICO. Then you're going to go and you're going to see about your whole household budget, your whole household financial picture. rsrlinks.com/keysteps. rsrlinks.com/keysteps. That's where you're going to monitor your credit. It's updated every week. You're going to get notified anytime your credit is run. That helps you with identity theft. You're going to be able to put in their simulations to say, hey, I got a bonus of $1,000. Where do I put it? It'll help with that. It'll tell you, hey, if you spend $1,000, this is what's you can expect to happen on your credit scores. It's going to help with your budgeting. It's going to help with your asset management. It's all right there. It's going to tell you when you're home ready, you can actually buy a house. All of that's right there on KeySteps. Want to know where you really stand? Again, visit rsrlinks.com/keysteps to get your financial house in order. Or if you're dealing with debt that's affecting your credit, check out rsrlinks.com/2step. rsrlinks.com/2step and see how strategic debt management might help. As you know, strategy beats rate always. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management, wishing you the best on your financial journey. That is the Your Credit Matters segment brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free. So I want to just mention again, I talked about it at the top of the hour, but if you weren't with us, I want you to hear this. It is a special program that we're doing called Take Two. Take Two. What is Take Two? Take Two only happens at a specific time of the year, and we are there. Got to get your mortgage application in right now. And you're going to go to sltloanapp.com, sltloanapp.com. Get your loan application in right now. If you're looking to do a debt consolidation, if you're looking to do a cash out, or you just want a lower interest rate, and if you're above 6 3/4, there is a possibility of a lower interest rate. Not saying it's guaranteed, but there's a possibility. We'll go through that with you. We need all of the documentation required for your loan in by October 20. Got it? It's a quickie. And then you get to Take Two. What does Take Two mean? Well, we're going to get the loan restructured for you, and it's going to get done in the first week or two of November. You're not going to make a November payment. You're not going to make a December payment. So you're going to take two, helping your liquidity for the holidays. Your first payment will be due in January of 2026. That's why we call it Take Two. So get on it right now. See if it helps you and your family. You are listening. As always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. Big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.